You pull out your wallet, grab a $20 bill, and what do you see? Federal Reserve note, not United States note, not Treasury note, Federal Reserve. But here's the question nobody's asking. Who the hell is the Federal Reserve? And why do they control every single dollar in your pocket? Today, we're pulling back the curtain on the biggest financial secret in America. This isn't conspiracy theory. This is documented fact. Let's start with what most people think. You probably believe the US government prints money, right? Makes sense. It's called the United States dollar. After all, the Treasury Department must be running the show. Wrong. The truth is, while the Treasury physically prints the bills, they don't control the money supply. They don't decide how much money exists. They're basically just the printer. The real power, that belongs to the Federal Reserve. The Federal Reserve isn't part of the government. It's not a cabinet department. It's not even mentioned in the Constitution. The Fed is what's called an independent entity within the government, which is a fancy way of saying it operates outside the normal checks and balances. So who created this system? And more importantly, who profits from it? The Federal Reserve was created on December 23, 1913, when President Woodrow Wilson signed the Federal Reserve Act into law. The bill was passed during a late-night session, right before Christmas recess, when many members of Congress had already left Washington. The system consists of 12 regional banks across the country, from Boston to San Francisco. But don't let the word federal fool you. These aren't government institutions in the traditional sense. Here's the structure. At the top, you have the Board of Governors in Washington, D.C., 7 people appointed by the President and confirmed by the Senate. They serve 14-year terms, which means no single president can stack the board with their own people. Then you have the 12 regional Federal Reserve banks, which are set up like private corporations. And here's the kicker. These regional banks are owned by member banks, not the government, not the people. Commercial banks. JP Morgan Chase, Citibank, Bank of America, they literally own stock in the Federal Reserve. In fact, national banks are required by law to buy stock in their regional Fed bank. The stock pays a fixed 6% dividend every year. But wait, there's more. The Fed operates independently. Congress can't audit them whenever they want. The president can't fire the chairman. They fund their own operations without congressional appropriations. They literally answer to no one on a day-to-day basis. Now let's talk about how money is actually created, because this is where your mind is going to explode. You deposit $1,000 in your bank account. You think that money just sits there, right? Wrong. The bank keeps maybe 10%, $100, and lends out the other $900. This is called fractional reserve banking. But here's where it gets wild. When the bank lends that $900 to someone else, they don't take it from your account. Your $1,000 is still there. They literally create new money. They type numbers into a computer and boom, the borrower takes that $900 and spends it. The person they pay deposits it in their bank. That bank keeps $90 and lends out $810. That bank creates more money, and on it goes. From your original $1,000 deposit, the banking system can create up to $10,000. This is the money multiplier effect. And guess what? Every single one of those dollars is debt. Someone owes that money to a bank with interest. Now, here's the Fed's role. The Fed controls how much banks can lend by setting interest rates and managing bank reserves. When the economy is slow, the Fed lowers interest rates, making it cheaper to borrow. Banks lend more, creating more money. They raise rates, making borrowing expensive. Banks lend less, and the money supply contracts. But there's another tool. The Fed can create money out of thin air to buy government bonds from banks. In 2020, during the COVID pandemic, the Fed increased its holdings of Treasury securities from $2.3 trillion to $5.6 trillion. That's $3.3 trillion created digitally. They didn't print bills. They just added zeros to a computer system. Who benefits from this system? Though let's follow the money. When the Fed creates new money to buy bonds from banks, who gets that money first? The banks. They can then lend it out, charging interest or buy more assets. This is why after every financial crisis, bank profits soar while regular people struggle. Here's a concrete example. During the 2008 financial crisis, the Fed created trillions in new money through quantitative easing. Stock prices recovered quickly. Real estate prices bounced back. But what happened to average Americans? Wages stagnated. Many lost their homes. The wealth gap exploded. The people closest to the money creation process benefit first. By the time that money trickles down to Main Street through loans and spending, inflation has already started eating away at the purchasing power of the dollars you worked hard to earn. Think about it this way. When new money is created, the total pool of dollars increases, but the total amount of goods and services doesn't magically increase with it. More dollars chasing the same amount of stuff means prices go up. Your savings lose value. Your paycheck buys less. Meanwhile, the banks that own shares in the Federal Reserve Banks collect their guaranteed 6% dividend every single year. No matter what happens to the economy, no matter how many people lose their jobs or homes, 6% like clockwork. And here's something most people don't know. The biggest shareholders in the New York Fed, the most powerful regional bank, are Citibank and JP Morgan Chase. As of 2018, these two banks controlled nearly 75% of the New York Fed's capital shares. Let's zoom out for a second. For most of American history, the dollar was backed by gold. If you had a dollar, you could technically exchange it for a specific amount of gold. This limited how much money could be created. But in 1971, President Nixon ended the gold standard. The dollar became what's called fiat currency, money backed by nothing but faith in the government and the economy. Since then, the money supply has exploded. The purchasing power of the dollar has decreased dramatically. What cost a dollar in 1971 now costs about $7. Your grandparents could buy a house on a single income now. Two incomes barely cut it for many families. Some economists argue this system allows for economic flexibility and growth. Others say it's a system designed to transfer wealth from the many to the few. The debate continues, but one thing is undeniable. The people controlling the money supply have immense power over the economy. So what can you do about this? First, understand the game being played. Your money is being devalued constantly through inflation. The system is designed to push you into debt, where banks profit from interest payments. Educate yourself about financial literacy. Understand how assets work versus cash. Know that holding large amounts of cash long-term means you're slowly losing purchasing power. Diversify. Don't put all your faith in a system where a handful of unelected officials can create trillions of dollars with a keystroke. And most importantly, ask questions. Demand transparency. The Fed operates with minimal oversight because we let them. The more people understand how money actually works, the harder it becomes to hide what's really going on. So there you have it. The Federal Reserve isn't federal. It has no reserves. And it's a system where private banks have ownership stakes, create money through lending, and influence the value of every dollar you earn. The next time someone tells you the government controls the money, you'll know better. And the next time you pull out that $20 bill, remember, it's not yours. It's a Federal Reserve note. You're just borrowing it. If this video opened your eyes, smash that like button and share it with someone who needs to know the truth. Subscribe for more content that breaks down the systems running our lives, and drop a comment. What surprised you most about this? Let's talk about it. Until next time, stay curious, stay informed, and follow the money.